Hello and welcome. Our presentation today will discuss ways to capitalize on charitable giving through effective charitable planning. I'm Reem Hussain, financial planner at Azzad. I'm confident you will benefit from the information we provide you today, but first let's get the disclaimers out of the way. This discussion is not meant as one-size-fits-all investment advice for any account type or recommendation for any particular security. We highly recommend that you speak to your financial advisor, tax professional, or attorney for information specific to your situation. First, some good news to report. Americans, including American Muslims, continue to demonstrate remarkable generosity. The graph demonstrates the increase in charitable giving between 1982 and 2022. It's undeniable that individuals play a significant role in charitable giving. In fact, individuals make up over 64% of total contribution made in the United States, far exceeding private foundations and corporations. So why do Americans give so much? Without a doubt, the tax benefits associated with charitable giving serve as a strong incentive, and we will delve into those benefits shortly. But of course, it's more than that. Studies show that charitable giving has a positive impact on happiness. When we know we are helping to support causes we feel passionate about or helping those in need, we tend to feel better about ourselves. And for us Muslims, it's one of the 5 pillars of our faith. We at Azzad help our clients fulfill their zakah obligations by making it easier for them to calculate their zakah on their investments and retirement accounts. But we go even further than providing calculations. We help our clients maximize their zakah so that more of their money goes towards supporting their favorite charities. In today's presentation, I will go over some of the strategies our clients use to maximize their charitable giving. But first, let's look at today's agenda. We are going to talk about what to give, when to give, and how to give, so that your charitable giving is more impactful both for you and your chosen charity. Let's start with what to give to charity. Most individuals make cash donation to their favorite charities. It's very convenient. It's a simple way to give. You choose how much you want to give and you make the check payable to the charity, and then the charity uses the cash donation as its wishes. Instead of giving cash, you may want to think beyond cash as a donation. You may want to consider donating long-term appreciated securities such as stocks, mutual funds, private company stocks, and other potential investments, even appreciated crypto. Why donate appreciated securities? The answer to this question is very simple. It's because of the capital gains. Capital gains are eliminated when you contribute long-term appreciated assets directly to the charity. Donating appreciated assets is a very tax-efficient way to give. You get a deduction based on the value without paying the capital gains taxes. Finally, you may consider the charitable giving through retirement account. It's a popular way to donate. If you are, for example, in retirement and you don't have a need for the money, you can choose to designate your favorite charity as a beneficiary of your retirement account. This will allow the retirement account value to pass free to the charity, and if you are over age 70 and a half, you also have the option to make a qualified charitable distribution from your traditional IRA directly to the qualified charity. And this transfer can fulfill some or all of your required minimum distribution if you are age 73 or whatever the RMD age is. And of course, you won't receive a tax deduction for a qualified charitable distribution, but the amount you transfer won't be included in your ordinary income for the year. This strategy can help you keep your tax bracket lower while maximizing the impact of your donation. There are several factors that influence the tax benefits we can obtain from charitable giving. First, the tax benefit depends on the entity that is receiving your donation, whether it is a public charity such as most donor advised funds and a large nonprofit organization, or private foundation established by affluent families during their lifetime. However, the primary determinant of the tax benefit lies in the type of property used to make the charitable gifts. Let's consider two examples: cash and long-term capital gain assets. Cash donation offer a straightforward way to give, providing you with a fair market value deduction capped at 60% of adjusted gross income within a single calendar year. On the other hand, donating stocks or other assets with long-term capital gains is another common form of charitable giving. In this case, the deduction also relies on the fair market value of the property donated, with a 30% cap of adjusted gross income within a single calendar year. It's worth to note that any donation exceeding these limits can be carried forward for up to 5 years. As we mentioned before, donating appreciated assets improves tax deduction. It's frequently recommended that giving appreciated property yields a greater benefit compared to giving cash. And here's a quick illustration to demonstrate this point. Let's consider a scenario where you own a property currently valued at $100,000 with initial cost basis of $20,000. If you were to sell the property, you would realize capital gain of $80,000, incurring a capital gain tax of just over $19,000, and this would leave you with approximately $80,000 to donate to your chosen charity. And that would result in a tax deduction valued at around $30,000 if we assume that the tax rate is 37%. Now let's explore an alternative option when you were advised to donate the appreciated property directly rather than selling it first. So returning the property, which still holds a value of $100,000 with $20,000 cost base, you avoid paying any capital gains taxes. The charitable contribution, or how much the charity would receive, would be the full fair market value of $100,000. That will lead to a deduction exceeding $37,000 for the donor. And when we talk about this strategy, it's often referred as a win-win situation, as it's benefit both the charity, which the charity will receive a larger donation, and also the donor, who gains an even greater tax advantage. Now let's talk about when to give. The US tax rates are progressive, starting at 10%, and the maximum marginal tax rate bracket is 37% for families with income level around $700,000. Generally speaking, you derive a greater tax benefit when you give in years when your marginal rate are the highest. For example, if you are currently working prior to your retirement, or if you realized a large capital gains during the year, giving to the charity offset the associated tax bite will be a smart choice. Another example, you might be considering a Roth conversion, which of course implies on recognition of additional income on that converted amount, and you can offset that with a larger charitable contribution in that particular year. Under the Tax Cuts and Jobs Act, the standard deduction roughly doubles, so the percentage of Americans that are itemizing deduction has fallen significantly over the last several years. Prior to the Tax Cuts and Jobs Act, it was estimated that roughly 30% of taxpayers itemizing deduction. Currently, it is estimated that the number is close to 11%. So because of that increase in the standard deduction, it's a little bit harder to exceed the standard deduction. So for example, the standard deduction for married filing jointly in 2024 is $29,200. To qualify for a tax deduction on charitable donation, you have to itemize your deduction. Apart from charitable contribution, there are various other deductions you can claim. For example, home mortgage interest, which can be deducted on loans up to $750,000, depending on your filing status. Also, medical and dental expenses exceeding 7.5% of your adjusted gross income. Finally, personal property taxes imposed by state and local government up to $10,000 and $5,000 if married filing separately. You can itemize your deduction if this total figure exceeds the standard number. As I discussed before, because of the higher standard deduction, it's a little bit harder to exceed the standard deduction hurdle to get an itemized deduction amount. So with that in mind, charitable bunching is a very effective strategy. And what I mean by charitable bunching is you bunch multiple years worth of charitable gifts into a single tax year. This provides you with a large itemized deduction total in 1 year. Then in subsequent years, you opt for the standard deduction. Let's take the following example to illustrate this. Consider a scenario where a couple pledged to donate $20,000 annually to their chosen charity. Let's assume that they have a $10,000 in state and local taxes available as an itemized deduction over 5 years. With an annual gift of $20,000, their total itemized deduction would amount to $30,000 each year, which is slightly higher than the standard deduction for 2024, which is $29,200. So in total, over these 5 years, they would receive itemized deduction totaling $150,000. Now let's explore the strategy of bunching gifts into a single calendar year instead of spreading the $100,000 donation over 5 years. So the client donates the full amount in 1 year for a higher tax benefit, and assuming that the same $10,000 as a state and local tax deduction, and the donation is going to be $100,000 to their charity. So the clients achieve an aggregate itemized deduction of $110,000 in the first year. In the subsequent 4 years, as no charitable contribution are made, the client benefit from the higher standard deduction. So in this illustration, the total aggregate deduction amount to over $226,800, and that provide an incremental benefit of additional $76,800 in deductions compared to the first scenario. The key question then becomes how to approach charitable giving. There are numerous methods available to fulfill one's charitable intentions. At Azzad, our planners work with clients to find ways they can capitalize on their charitable giving. Now let's move to talk about which charitable giving vehicle is the right one for me. Choosing the right giving vehicle depends on several factors such as family values, tax consideration, financial requirements, and the nature of assets being donated. Let's start with direct giving, giving through qualified charitable distributions, QCDs. Understanding the qualified charitable distributions starts with understanding required minimum distributions, RMDs. Once individuals reach age 73, they must start taking yearly distributions from their IRAs, regardless of their financial or personal desire or financial necessity of these funds. These distributions contribute to their overall taxable income, potentially nudging them into a higher tax brackets. In addition, they can trigger phase-outs, limiting or even eliminating certain tax deductions like personal exemptions and itemized deductions. Additionally, they may lead to a higher taxes on Social Security income or elevated Medicare premiums. So qualified charitable distributions offer a solution by directly transferring funds to one or more charities. Individuals can satisfy their required minimum distribution obligation provided the total distribution do not exceed $105,000. Since the QCDs do not add to taxable income, they effectively sidestep both higher tax rates and phase-outs, offering a tax-efficient way to fulfill RMD requirements. In this example, we have a married couple age 72 with an annual income of $200,000. Let's consider two scenarios. One where they do not utilize the qualified charitable distributions, QCDs, and donate $20,000 in cash to charity. And another scenario where they opt for the QCDs. In the first scenario, without the QCD, they donate $20,000 in cash to the charity. And since their standard deduction of $29,200 exceed the charitable donation, and assuming no other itemized deduction, they will take the standard deduction. Therefore, their taxable income becomes $170,800, resulting in a federal taxes of $27,682. On the other side, if they opt for the QCD, their adjusted income reduced to $180,000 after the $20,000 donation. Taking the standard deduction of $29,200, their taxable income decreased to $150,800. This will result in a federal income tax of $23,282. Therefore, by utilizing the QCD, they save $4,400 in federal income taxes. Let's move on to indirect giving, giving through a donor advised fund, DAF. A donor advised fund is a separately identified fund or account that is maintained and operated by Section 501(c)(3) organization. The donor advised fund allows donors to make a charitable contribution, receive an immediate tax deduction, and then recommend grants from the funds over time. Donors can contribute to the fund as frequently as they like and then recommend grants to their favorite charitable organization whenever it makes sense for them. A DAF is like having your own private foundation, but it requires less money, time, legal assistance, and administration to establish and maintain. Contributing assets to the donor advised funds allow you to claim the tax deduction in the year contribution rather than when the funds are actually distributed to the charities. In addition, assets transferred to the donor advised fund are exempt from capital gains taxes, making it advantageous for donating appreciated securities. The fund grows tax-free until you decide to donate to chosen charities. Another vehicle is donating by creating a private foundation. Private foundations operate similarly to the donor advised funds, where a tax-deductible donation is made to the foundation, typically established by a donor as a private charity. The foundation, structured as 501(c)(3) charity, then distributes grants to various charities aligned with the family's philanthropic goals. While the setup shares similarities with the donor advised fund, the tax deduction limits are slightly lower for a private foundation. So charitable deductions are limited to 30% of AGI for cash and 20% of AGI for long-term appreciated securities. Private foundations are exempt from federal income tax. However, the investment income is subject to 1% or 2% excise tax. So in general, private foundations offer greater flexibility in grant making, suitable for families seeking control over their charitable endeavors, including board composition and charity selection. On the other hand, the donor advised funds are limited to granting to public charity, providing a more restricted philanthropic scope. It's essential to align the chosen philanthropic vehicle with the desired level of control and charitable objectives. Here are some of the advantages and disadvantages of giving by establishing a private foundation. Private foundations offer you more control over your philanthropic endeavors, the ability to establish a lasting legacy through perpetuity, and the tax benefits such as immediate tax deduction and potential tax-free assets growth. In addition, they provide flexibility in grant making, allowing you as a donor to support diverse charitable activities and involve multiple generations of family members, fostering unity and values. However, these benefits come with the drawbacks. Private foundation entails a considerable administrative burden and a cost for legal and accounting services, along with the requirement to distribute a minimum percentage of assets annually, which is potentially limiting the long-term wealth accumulation. Additionally, they lack the transparency and public engagement obligation of public charities, which may raise concern about accountability and conflicts of interest within the family governance structure, impacting the foundation's effectiveness. Another way to give to charity, and one that is popular with high net worth clients, is donating using a split interest charitable trust. A charitable remainder trust operates differently from any other entities. Rather than directly donating to the charity, the individual contributions goes into the trust. In a charitable remainder trust, the donor or the grantors make a gift into the trust, which then generates income by reinvesting its assets. This income is returned to the grantor for a specified period, such as 10, 15, or 20 years, while the remainder interest is allocated to the charity upon the trust termination or the grantor's death. These structures allow donors to convert property into income-generating assets, receive income from a predetermined period, and ultimately benefit charities with the remainder interest. Additionally, donor can claim a tax deduction for the present value of a future charitable gifts upon making the initial contribution to the trust. Charitable remainder trusts are commonly utilized by individuals with low-income properties or assets with a low basis. By placing the assets into a charitable remainder trust, the donor can convert them into income-producing assets utilizing the tax deduction to facilitate the process. In contrast, the charitable lead trust operates in the opposite direction to the charitable remainder trust. In this arrangement, the trust income is directed to the charity for a specified period, whether it's 10 or 20 years. This setup offers tax advantage as the trust's income benefits the charity during its lifespan. Eventually, at the trust termination, which could be after a set period, the trust assets revert back to the donor. And the tax deduction calculations involve factors like expected income stream to the charity and the discounted remainder interest, which professionals can compute using a specified software. You might assume that setting up a charitable lead trust is complex and costly. However, Azzad can assist you in establishing this solution through a straightforward steps. So first step, you will need an attorney to draft the trust document, and Azzad can facilitate the communication between you and the attorney through the process. In addition to that, you will need to select a trustee or administrator to oversee the management of the trust. And also each year, the trust will be required to file Form 5227 as a split interest trust return. Also, you will need to designate a non-charitable beneficiary, such as your grandchildren, and you will then need to determine the percentage of assets allocated to the charity annually and the duration of the trust. And upon the trust termination, all the remaining assets will be passed on to the non-charitable beneficiary. Sometimes individuals can make mistakes with their donations. This is why it's important to work with a professional, and here are a few things to keep in mind. A QCD from your retirement account, if you are over 73, 74 years old, cannot be deposited to the donor advised fund or a private foundation, as they are not considered to be qualified charitable organization for this purpose. A QCD is required to be reported on Form 1099-R as a taxable distribution by the IRA custodian. The taxpayer and the tax preparer are responsible for excluding the distribution from the income on the tax return by following required Internal Revenue Services (IRS) reporting procedures. A QCD is not reported as a charitable contribution in Schedule A as an itemized deduction because it's excluded from income. Grants from a donor advised fund are not reported as a charitable contribution on Schedule A because the original contribution to the donor advised fund was reported as a deduction in the year assets were contributed into the donor advised fund. A donor advised fund account is not subject to an annual required grant amount or percentage. And before we wrap up, do make sure to check the credential of the charity you wish to donate to. You want to make sure that they are 501c3 public charities. This will be done for you by your charitable administrator if you donate using a donor advised fund. You also want to consider making a bigger contributions to fewer organizations. You can truly maximize your donations impact that way rather than giving a very small amounts to numerous charities. Finally, do not wait. Don't put off charitable planning. Do it now. Thank you so much for your time today. As you can tell, we at Azzad are passionate about helping you understand the best ways to give to charity. For more information and timely updates, please follow us on social media and visit us at azzadasset.com. We hope that you enjoyed today's presentation. Thanks again.